Imagine the retail giants like Walmart and Amazon diving headfirst into the world of stablecoins, a move that could either revolutionize their business models or introduce significant new risks. But here's where the debate gets heated. Should investors be thrilled by this innovation or approach it with caution? The possibility of bolstered profits for these retail titans hinges on two major factors. On June 5th, Circle Internet Group, a leading cryptocurrency firm behind the popular stablecoin USD Coin, USDC, launched its initial public offering IPO and saw a remarkable market response. The stock has surged over 75% since trading began, signaling strong investor confidence in this rapidly evolving sector. Stablecoins have been around for a while, but their future was murky due to unclear regulations until the July enactment of the Genius Act. This legislation, officially known as the Guiding and Establishing National Innovation for U.S. Stablecoin Act, marks a turning point. It brings much-needed regulatory clarity, encouraging major retailers to prepare for their entrance into this space. Walmart and Amazon, the behemoths of retail, have quietly been strategizing behind closed doors to possibly issue their own stablecoins. Now, investors everywhere are wondering, is this a golden opportunity or a risky gamble? Why are big retailers so interested in stablecoins? According to the Wall Street Journal, executives from both companies are exploring the idea of launching proprietary stablecoins, which are digital currencies pegged to a stable asset like the US dollar. For each stablecoin in circulation, an equivalent dollar is held in reserve, maintaining its value. Currently, retailers handle vast volumes of credit card payments, which come at a steep cost. Payment firms like Visa and MasterCard charge around 3% per transaction. This fee represents a substantial drain on Walmart's and Amazon's bottom lines. By cutting out traditional payment processors through stablecoins, they could recapture some of these costs. Moreover, companies issuing stablecoins generate revenue from the large cash reserves backing these coins. To put this in perspective, Circle earned approximately $1.2 billion in the first half of 2025 alone, owing to the over $60 billion it holds in reserves for its USD coin. If Walmart and Amazon issue their own stablecoin, they wouldn't just save on processing fees, they could also profit from the interest on the vast reserves tied to these coins. Given the new regulatory framework provided by the Genius Act, it makes sense why these retailers are eager to accelerate their stablecoin plans. But what are the potential downsides? One major concern is consumer safety. Unlike traditional bank deposits, which are insured, stablecoins currently lack such guarantees. If numerous entities, from retailers to financial institutions, start issuing stablecoins, there's a risk that reserves could be mishandled, potentially resulting in significant losses for holders. In a worst-case scenario, if a major stablecoin issuer fails, it could spur tighter regulations and shake the public's confidence in digital currency. For investors, however, the outlook might be more optimistic. Amazon's operating profit margin in North America stood at only 6% in the first half of 2025, while Walmart's profit margin was even slimmer at 4% for its fiscal year ending January 2025. Reducing payment processing fees through stablecoins could meaningfully increase these margins. Don't count out the credit card companies just yet. Visa, MasterCard, and others are responding proactively by developing their own stablecoins and building infrastructure to support stablecoin transactions for banks and other institutions. While the rise of stablecoins may disrupt their traditional model, these payment giants seem ready to adapt, offering some reassurance to their investors. Changes on this scale won't happen overnight, giving Visa and MasterCard shareholders time to adjust as the landscape evolves. For investors, the burgeoning stablecoin market presents an intriguing opportunity. Those investing in stablecoin issuers may find lucrative returns as adoption spreads. And retailers could see improved profitability by cutting payment fees. In summary, while Walmart's and Amazon's stablecoins might never achieve widespread usage, the potential rewards are substantial if they do catch on. Consumers should remain aware of the unique risks stablecoins pose, particularly around reserve security that traditional bank deposits don't carry. Ultimately, from a big picture perspective, this emerging stablecoin trend offers a promising avenue for investors willing to navigate the risks and rewards. What do you think? Is this the future of retail payments or a risky experiment? Share your thoughts and join the conversation below.